Hey, it's Dan from the Scientific Games Group, and in this video, we'll be talking about Scientific Games' strengths and weaknesses when it comes to their financial ratios. Financial ratios give us a quick view of how the company is doing and provides a metric to compare companies with competitors. There are 4 different types of ratios that I will discuss. These are liquidity, leverage, activity ratios, and profitability ratios. These will provide an overview of Scientific Games' performance and operations, as well as how they stack up to the rest of the industry. To begin the ratio analysis of Scientific Games, we will talk about liquidity ratios. Liquidity ratios show how quickly a company can repay short-term debts and the amount of short-term assets a company has. The liquidity ratio that we will discuss is the current ratio. This looks at a company's short-term assets, such as cash and equivalents, accounts receivable, inventory, or any other asset that will turn to cash within a year compared to its short-term liabilities. The industry's current ratio is 0.71, which means that most companies in the gambling industry have more current liabilities than current assets. This is not the case for Scientific Games, however, because they have a current ratio of 1.83. This can be a positive and a negative, as they will be able to pay short-term creditors, but they could be using their capital in a more efficient way. The next category of ratios is leverage ratios. These describe the capital structure of the company. These are important because they show how much debt the company has and how they finance their operations and business. Total debt to enterprise value is a leverage ratio that compares the proportion of debt that makes up the company's total net worth. Scientific Games has a debt to enterprise ratio of 0.86, while the industry average is 0.64. This means that Scientific Games carries more debt than their competition. This could be because they have to borrow more money when they operate with a net loss, and with the company becoming more profitable, we should see the debt to enterprise value ratio decrease. This poor debt to enterprise value ratio is combated by Scientific Games' very favorable current ratio that we just discussed, and Scientific Games should not have a problem paying off the debt that they have. Activity ratios show how companies operate and how the company is able to turn balance sheet items into revenue for the company. These ratios show how efficient a company is and how well they are utilizing their assets. The activity ratio that we will discuss is inventory turnover. This is a number that shows how many times per year the company's entire inventory is sold and replaced. For Scientific Games, the inventory is 5.71. This is most likely a combination of fast-selling lottery products that move through the inventory quickly with some slower-moving gaming products and gambling systems that might stay in inventory for longer periods. Regardless, Scientific Games is able to move product at a favorable rate so they can stay in optimal production and decrease losses based on storage costs. The final type of ratios are profitability ratios. Profitability ratios show how effective a company is when it comes to turning top-line revenue into bottom-line net income. They show if a company needs to focus on making more money and expanding, or tightening up on expenses and becoming more of a lean operator. This is a metric that Scientific Games struggles at because they have been operating at a net loss for the past 3 years. With that being said, the price to earnings ratio of Scientific Games competitors is around -19, while Scientific Games is around -6. The competitor price to earnings ratio is so low because one outlier has a PE ratio of -132. Overall, even though Scientific Games has a negative price-to-earnings ratio, this does not mean that the company is not in a good spot, as their PE is beat by only 3 of their competitors. The next profitability ratio to discuss is enterprise value to earnings before interest, taxes, depreciation, and amortization, better known as EBITDA. EV to EBITDA is a ratio that takes debt into account when looking into the overall value of the company compared to the amount of income a company has. Many competitors have an EV to EBITDA ratio of around 11, while Scientific Games EV to EBITDA is 8.86. This is because of the company's inability to turn a profit in the recent years. In conclusion, Scientific Games is a company whose financial ratios struggle because they have been operating a net loss for the last 3 years. Despite this, they have kept strong liquidity ratios, and this will allow them to jump on potential opportunities and pay off any debt that is upcoming in the future. Thanks for watching.